So how important and indeed how urgent is it that financial institutions do get a kind of proper view of their cash positions?
Well, it's hugely important. We have some of the most complex processing on the planet, really, within the banking and financial system, as witnessed the last few years. I think have made that very clear to people. And so the value of being able to get a handle intraday on what's going on with your money is, to a degree, the elephant in the room. There's been a lot of talk about overall liquidity long term, but knowing what you've got that day so you can invest it, for example, is fundamental. Now, why does that matter? Number one, there's a straight revenue equation here, which is if you're investing money at the end of every night, which you do, the more you can get that accurate, the better. So for example, interest rates now are very low. They're only going to go in one direction. It's big in the FT and big in the press. If you've got a $15 billion book, which is not big by financial institution standards, even if you're just keeping a 5% investment cushion, every 1% that interest rates go up is going to cost you $7.5 million per annum. That's just maths. And we know of many organisations who know and say that they're flattening their positions, but on analysis we discover that they're not. For example, on minor currencies, discovered that they were losing approximately $15 million per annum just through not investing. Another example where a bank was absolutely correct in flattening its positions in sterling, in dollars and in euros. When we examined Japanese yen, we found that 64% of the balances by value were held in what it called small transactions that were not worth looking at. So 2/3 of that potential investment was being given away.
Sure.
The other urgency issues here, of course, are regulatory and the effect on client service, because if you're offering early cut-off times, your clients will go to somewhere with a late cut-off time. If you're having errors on your client transactions, again, they'll move to a financial institution that doesn't do that.
Sure, sure. So what are the institutions here risking if they don't get their houses in order?
The regulators are getting more and more interested in intraday liquidity. There's been a lot of talk about breaking up banks, about bonuses, and of course about stress tests and about having capital buffers. But if you look into the regulations, the Basel III Principle 8 talks explicitly about the need for having a handle on intraday liquidity, which means knowing where all your money and assets are during the day. In the same way, the FSA Policy Statement 0916 talks about the cause of the crisis being down to intraday liquidity, which is absolutely spot on. So your risk, and other regulators incidentally are doing things without writing any regulations. So we know of one bank, for example, that was told directly by the Monetary Authority of Singapore and by the Hong Kong Monetary Authority that Excel was not a suitable system for holding intraday information.